Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The dollar has come back down. Stock indices are buying back the dip. Gold is setting records, and Bitcoin is pondering its fate. For a while, the US dollar became the cleanest shirt in a laundry basket. Treasuries were not being sold off as quickly as European bonds. Yields on British gilts soared to their highest levels since 1998. For French debt, it was the highest since 2008, and for German bunds since 2011, against the backdrop of concerns about fiscal discipline. Investors are concerned that Rachel Reeves will not be able to close the £35 billion budget gap, that François Bayrou's government will resign, and that Friedrich Merz has gone too far with fiscal stimulus. Against the backdrop of political unrest in France and fears over the global debt crisis, the US dollar was bought as a safe haven asset. Rumors of Hiroshi Moriyama's resignation as leader of Japan's ruling Liberal Democratic Party did not allow the yen to resist the dollar. Disappointing US labor market statistics helped bring the greenback bulls back down to earth. Job vacancies fell to their lowest level in 10 months. Hiring slowed, and the unemployed needed more time to find new jobs. As a result, the futures market raised the chances of the Fed's monetary expansion in September to almost 100%. The USD index retreated from the upper limit of the consolidation range from 97.6 to 98.6. The US stock market began a difficult period with a decline but quickly recovered. September is the worst month for the S&P 500. According to research by Bank of America, since 1927, the broad stock index has fallen in 56% of cases, by an average of 1.17%. The first year of a presidential term has been even worse, with 58% cases of decline, averaging 1.62%. UBS claims that over the past decade, the market has fallen by an average of 2% in September. The S&P 500's fundamental valuations do indeed appear to be overestimated. They exceed 22 times expected annual earnings, which has not happened in 35 years, except for the dot-com bubble and the pandemic. Market concentration is now at its highest, with the share of 6 technology giants in the broad stock index exceeding 30%. In such conditions, news from large issuers can shake the entire market. Unsurprisingly, news that Alphabet had avoided a strict antitrust ruling to sell Chrome, and that Apple intended to launch AI-based web search tools for Siri, allowed the S&P 500 to quickly recover its lost ground. Mass sell-offs in the global bond market have boosted demand for safe haven assets and pushed gold to record highs. Governments actively increased borrowing during periods of ultra-low interest rates, but these rates rose significantly between 2022 and 2024. As a result, the US is paying 4 times more to service its national debt than it did before the global financial crisis, and more than it spends on defense. The federal appeals court's ruling that the tariffs are illegal will require a refund, increase the budget deficit, and lead to an increase in the volume of Treasury issuance. Investors are actively getting rid of them, and the money is settling in the gold market. High demand for precious metals is supported by ETF buyers and central banks' intention to increase their bullion purchases after a slowdown in the second quarter. The reserves of the largest specialized fund, SPDR Gold Share, have reached their highest level since August 2022. Expectations of a Fed rate cut are creating a tailwind for gold. However, Morgan Stanley forecasts that it will fall to 2.75 to 3% in 2026. Bitcoin continues to be in the red. It is losing out to Ethereum and other cryptocurrencies amid falling volatility. The surge in gold prices to record highs is leading to capital outflows from the digital asset market. Yesterday's leader has lost its connection with the US stock indices. Neither the S&P 500's record highs in August nor its rapid recovery after the September slump brought the Bitcoin bulls to their senses. Bitcoin has not yet joined either the defensive asset camp or the risky stock camp. This raises the question, why is it needed at all? At the same time, the 5% decline in Strategy's securities is causing concern among cryptocurrency enthusiasts. Michael Saylor's company is the flagship of the so-called crypto treasuries. They have accumulated $70 billion worth of Bitcoin. This represents more than 3% of all tokens issued. If there are sell-offs to maintain positions in the stock market, the Bitcoin correction will accelerate. The key events of the second week of September will be the ECB meeting and the publication of U.S. inflation data for August. The European Central Bank is expected to leave its deposit rate at 2%. Nordea predicts that the cycle of monetary expansion is over. This contrasts with the view of Bloomberg experts, whose consensus estimate suggests that another step should be expected in 2025. Crédit Agricole expects the deposit rate to rise by 75 basis points in 12 months, amid an acceleration in the European economy, thanks to fiscal stimulus. Divergence in monetary policy will keep the Euro-USD pair on an upward trend. In September, investors will listen closely to Christine Lagarde's comments on the situation in the European debt market. Trading Economics forecasts an increase in consumer price growth in the U.S. from 2.7% to 2.8%. Core inflation will stabilize at 3.1%. The Fed has made it clear that it is more concerned about the labor market. However, the acceleration of CPI may prevent the central bank from cutting rates in the future. On the contrary, a slowdown in inflation will pave the way for aggressive rate cuts, weaken the dollar, and allow stock indices and gold to rise. Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.